Oh, okay, I think we're ready to get started. So I think we're recording here. Okay, so all right. So today, what we're going to do, really the only activity that I had was to talk about the exam. So I'm going to do a review session. Two things before we get into this, though. I wanted to note that one of your classmates had pointed out that there was a mistake on the first exam, and it was a duplicate question or duplicate answer, I should say. And I had asked him to look into it. So we found out, go through it because you're talking about 25 students times 40 questions. So it was like 1,000 questions, and they're all randomized. So we can't, it's not just a matter of looking at question 25 on everyone's exam. So, but we did find it. And then in some cases, I just adjusted it because it was a question dealing with when the something, it starts with when. It has to do with high function. And it is something about if the cost of production is going up and the supply curve shifts left, which is a true statement. But it's got that answer twice. And so if you put the wrong answer that was not coded to be correct, you got it wrong. So I adjusted everyone's score for those who did miss it. And it wasn't everybody, it wasn't even the majority of people, but I did fix that. So I just want to let you know if you did see that, that's been corrected and adjusted. So I apologize for that. I do try to do my best at looking over those exams to make sure that we don't have any duplicates, but sometimes these things do slip through, but I always try to give you the benefit of the doubt. That does happen. Okay, so there's that. The thing is, I emailed everybody last night an Excel file. Well, no, I didn't email. I actually posted it in the Brightspace website. It's too late. I thought, some people's email rings, through their phone. I didn't want to wake people up. It was about 12 o'clock. So, but I posted an Excel of the spreadsheet that I put on the far board over there. And it's the one that, and when I first put this together, I've never been in this room before until this class. I didn't realize that the camera was being partially blocked by the projector. And so I just didn't realize that. I don't think anybody would have realized it actually. So I went ahead and posted it. And I also posted the Excel file as an attachment in case you wanted to open it up. The formulas and all that. The formulas help to describe how those were all calculated. So anyway, so those are the two pieces of business there. So let's talk about the exam, and that's really my only activity for today. If you have questions for me that you brought, either if you're here in class or on the Zoom session, feel free to hit me with those, and I'll answer any question you like. This entire class session is really for your benefit. So the second exam is going to be available tomorrow. It's mostly done. I'm still tweaking it a little bit. And so it'll be available tomorrow. So it'll be available probably in the afternoon would be my guess, probably later in the afternoon. So look for that, and it'll be available Thursday, Friday, Saturday, and all day Sunday. So Sunday the 26th is the final due date. It's going to cover chapters 5, 6, and 7. So if you note on the syllabus, chapter 4 was initially assigned, and one of the things that I said a couple of weeks ago, or 3 weeks ago, or whatever it was, that we were going to skip that chapter. In fact, I think I skipped it last semester in this text because I think it includes a lot of things which I don't think are really that germane to what we're doing in micro. So, and the main topics in that I'm going to pull out and we're going to cover when we get to, I believe it's chapter 16, but that's down the road. So we don't have to worry about that. So it's chapter 4, which is a labor and financial markets chapter, is not going to be on this exam. So you don't have to worry about that. So chapter 5 deals with elasticity. And we're going to, there are a number of questions on the exam dealing with elasticity. And we talked about 3 different kinds: the price elasticity of demand, the cross price elasticity of one good in relation to another, and the income elasticity of demand. So those are 3 covered there. Chapter 6 deals with utility and the economics of the consumer. And chapter 7, I think, is really a very important chapter. Actually, there are 2 very, very important chapters in this particular segment. Chapter 5 and 7 are both very critical. Chapter 7 is particularly useful as we get into the next few weeks. We're going to be dealing with market structure, and that will be important, but let's not worry about that right now, other than to focus on what is covered in chapter 7 and what are some of the important elements you want to focus on there. So let's talk about the exam and talk about what to expect. So they're going to be, I should have probably written this on the board here. Well, that's all right, I'll just tell you. So it's going to be the very same format as last time, 40 questions, multiple choice, and you'll have 90 minutes to take the exam. I think that's really a good amount of time, and it's more time actually than what students have if we do it in class. if it's an hour and 15 minutes, it's 75 minutes. And I just am sort of allowing for, computers being slow, internet connections being bad. Our Brightspace server is pretty good, actually. Sometimes the old Blackboard system kind of crashed on people, and people were always frantically emailing me at 11 o'clock on Sunday night, and that doesn't really happen with Brightspace. So that's, say what you will about Brightspace, that's one of the good things. But if you do have an issue, let me know. Just send me an email, and we'll figure out what to do about it. But I crash you. But so I built in 90 minutes. I think that's probably a good amount of time to do it. Most people don't take that long, and I get a report that shows how long it takes. So let's talk about the exam. There are a couple of questions just dealing with what the general elasticity of demand, what that is. And it's simply put, it's the sensitivity or the responsiveness of the demand side of the market to a change in the price of the product. And that's really all that it really is. We gave a couple of different formulas, and I don't think there are any calculations on this exam, except for very basic ones. And so you may want to have a calculator, but just very basic calculations, I think. Like there'll be a question, I know there's a question dealing with if there's a 5% increase in the price of the good, then what happens to the quantity? And the quantity demand does this, then what is the demand? Well, you don't maybe have to use a calculator, but you could probably look at it just by viewing it and say, oh, okay, well, it's price elastic or inelastic, just given that. And I know there's at least one question on the exam that'll give that scenario. Remember, it's the price, the percentage change in the quantity demanded divided by the percentage change in the price. So if elasticity is greater than 1, we say it's price elastic. If we say demand is price elastic. Is it snowing now, or is that rain? Is that rain? Okay. That blind was closed when I came in, and I thought, I'll open it just so but I thought, well, I'm just going to look out, and but I'm just being the one to look out there. So anyway, so that's what. So if it's greater than 1, just know that. What does that really say? It's saying the demand side is very sensitive to the price of the good. And so, and because what determines price elasticity? One of the big ones is the availability of substitutes. And if I can get out of buying this good because the price is going up and I can buy something else, I'll do that. Now, there's not really any good substitute for, like gasoline. You can go to one gas station or the other, but you can't really stop buying gasoline if you want to drive. Now, obviously, there are substitutes for driving a car, like taking the bus or an Uber or whatever. Those may or may not be good substitutes. In fact, I'm probably all that cost effective. I haven't taken one in quite a while, but those are substitutes. But gasoline is a very inelastic good in terms of demand because of the fact that we pretty much have to buy it. So if the price of gas goes to $5 per gallon, we're going to probably pay that, and we're going to buy about the same amount. If it goes to $10 per gallon, well, that might be a different story, but that's probably not going to happen. So, but that's what the issue is with elasticity. So that's what the definition of it is: percentage change in quantity demanded by the change in price, percentage change in price. And so just know what those are. So the number of questions really dealing with these sort of definitional issues, responsiveness, sensitivity, that. It is percentage change in price, Also, let me see here. You want to know about those ratios. So if it's greater than 1, it's elastic. If it's less than 1, it's inelastic. So if it's exactly equal to 1, we say it's unit elastic, or sometimes it's referred to as unitarily elastic. That means it's mostly proportional. The quantity demanded in response to percentage change in price. So you kind of just want to know that. First set of elasticities is the most important one. We do cover a couple of others, and I'll get to that in just a second. So just know about what's going on there, and also know too that know about the issue of revenue. And your text gets into this quite a lot. And let's talk a bit about this revenue issue, because I think it's something that really bears some going over and some repeating, because I do think it's really important for us to know. Because your text did get into it quite a bit. And it really has to do with sensitivity of one variable in relation to the other. So I'm going to swivel the screen here the best I can. And remember what the issue is with price elasticity of demand. It has to do with frankly, the power in the transaction. I don't think there's really any more starkly efficient way of discussing it, but it's the power in the transaction. So if the demand is elastic, it means that the buyer is the one with the power. You raise the price of the good. Remember, the law of demand says if the price of the good goes up, the quantity demanded goes down. Well, all price elasticity of demand is telling us is how much. Price goes up a little bit, the quantity demanded falls a lot. That means it's very price elastic. And so as a result, what happens is if the price goes up just a bit and the quantity demanded changes a lot, then what ends up happening is the quantity changes more than the price. So total revenue going to the seller will go down. Total revenue will go down to the seller. So this is why sellers can't really increase the price of the good on demands, which is price elastic. So E sub D is greater than 1. If the price goes up, then the price goes down, the quantity demanded is going to go up in a great way. And so here, what the total revenue will go up instead. Right? So what you want to do is not raise the price, but lower the price. Lowering the price is actually what brings revenue up, because people will come to you because they like the price and they're very price sensitive. So this is a revenue issue. And remember, all the revenue issue is, total revenue is price times quantity. And so all we're really saying here is the idea that if the price goes up and quantity demanded goes down, we're saying the quantity goes way, way down here to the point where the revenue to the seller goes down. So sellers don't have pricing power. So and pricing power, when we refer to pricing power, we're almost always talking about seller's pricing power. That is, can the seller raise the price of the good? And right now, in these last, year and a half, 2 years, we've seen sellers have lots of pricing power. We're in an inflationary condition. I just bought movie tickets for my wife and son and myself. And it's like they're like double what they were like a year and a half ago. It's like I didn't realize that. I hadn't been to the movies in a while. I guess maybe I'm a little bit surprised at their pricing power given the subsidies, but you know what I mean? I went in and paid it. So you get the idea. If the price goes down, people come in, so total revenue goes up. So this is if it's elastic. If it's price inelastic, that is, it's less than 1. If the price of the good goes up, the quantity demanded is going to go down, but not very much. Well, total revenue will actually go up. And so for goods that are very price inelastic as to demand, sellers will oftentimes raise the price of the good as much as they possibly can to extract the most money from the seller, from the buyer. And some examples of this are things like extreme luxury goods, things like pharmaceutical drugs. If we wonder why the price of drugs, that is, medications goes up and up and up and up, because people don't have much choice. They can't really stop buying it. And as a result, some of these drugs cost thousands of dollars per year. And these are not rare conditions. These are very common conditions, but people feel like they have no choice but to buy it because it's what's prescribed for them. And if the price of the good goes down, well, you wouldn't want to do that if you're a seller, because in that case, total revenue will go down. So it's just the opposite condition. This is an elastic demand. Remember, it refers to the demand side, and this is inelastic demand. So just know what that relationship is and the implications on the seller. Okay, and so that's an important thing to talk about. We got into this a little bit in class, this idea, but most of the discussion I'm sort of deferring until we get to the next chapter, when we're going to start talking quite a lot about revenue. But this is an implication. The point I want to make here is, and I think there was a slide in the PowerPoint package, I believe there was at least, that talks about the fact, and I know in class I said that what looks like a strictly demand concept, that is price elasticity of demand, well, even the term sounds like it's a strictly demand side concept. It's got lots of implications to the seller, really. It really does, because sellers need to know what the price elasticity of demand for their goods is, for all their goods. And as a result, it determines their pricing policies. And so it kind of goes a little bit against what I think a lot of conventional wisdom or experience, whatever may sort of point up to us, because I think a lot of times we think, okay, well, we figure out what it costs to make the good, and we just simply mark the good up. We just simply mark up the price of the good. I think that sometimes in the accounting world, we probably oversimplify that by just saying, okay, it's 20% markup or whatever over the cost. But in reality, the seller wants to find out what the buyer is willing to pay. And this is why they do all kinds of surveys and 2-for-1 offers and all that to determine what the demand curve looks like. And when I say looks like, I'm trying to figure out how the slope is set up. Okay. Is it steep, meaning inelastic, or is it flat elastic? Okay, so questions about that, what that's all about. I think it's a really important concept for us to be aware of. And so we just want to know about that. And so again, the questions that might deal with math, you can use a calculator, but they're not going to be severe. You're not going to have to. Remember, I did a pretty nasty formula on the board, the midpoint formula. You're not going to have to do that. I just demonstrate how it all fits together. Okay. All right. So you want to know what these determinants of price elasticity of demand are. We gave a few. Number one was the price and availability of substitutes. If there are substitutes available, demand tends to be more price elastic. If there aren't substitutes, inelastic, because it's insensitive. We also talked about the price of the good in relation to income. So if the price is very, very small, insignificant almost, then a doubling the price is not going to bug us very much. So something like matches or lighters or all the things that we see as we check out of a grocery store or drugstore, it's really inexpensive stuff, but it's got extremely high margins. They can manipulate the price. Things like lighters and keychains and shot glasses and decals and little knick-knack kind of things. Those are all priced very expensively. If they double the price, you're probably not going to worry about it. Candy bars, stuff like that. This is not a big percentage of most people's incomes, and so people are going to pay the price. So that's another issue. There's the percentage of the price of the good. If it's a very expensive item like a car, yeah, people are going to be more sensitive to that. So they're going to be, and that's one of the few goods in which people actually sit down and bargain over the price. We talked about this scenario where if you walk into a Walgreens or whatever and start to haggle over the price of a candy bar, you probably get thrown out because you're up to no good, and they probably would, and you know that sort of thing. So you get the idea. That's one of the determinants there. Also, we talked about another element of elasticity that deals with tax incidence, and we didn't get into it as nearly in depth as the textbook did, but just know that when we talk about tax incidence, what are we saying here? Tax incidence refers to the division of the tax of a goods tax between buyer and seller. And I know that this sometimes goes against what we think about in our own experience. If we buy a good in a store, we pay, it's $5, we pay $5 plus tax. And I think we all are conditioned to that. But the issue of tax incidence suggests that if the demand is very elastic, then the seller will simply lower the price of the good to absorb the tax so that they don't get over your drop dead price. Okay, and that's a way that they can do that because the state is careless what price you're charging as long as they simply collect the tax. And we talked about the idea that it seems like a real sort of a schlocky sales tactic when you go on TV commercials. Hey, we'll pay your sales tax for furniture or motorcycles or whatever. But in fact, that is true. They can do that if they do the price. That's what happens. They simply lower the price of the good because demand is price elastic. And for goods, there are some goods in which there's a price at which the threshold is there. They don't want to break above it, including tax. And fast food meals used to be that. $5 was like the break-even point or the drop dead point for a long time. And now we've flown through that. Now we're pushing our way up to $10. So I think we're now sort of hovering at the $9 before we get to 10. So they really don't want to sort of push above that because of the fact there's this psychological thing. We're going to talk about that a bit later, this idea of these psychological issues with regard to pricing, and that's coming up a bit later in the class. And I'm not a psychologist, and in fact, I'm not even a behavioral economist, but these are issues that are very important to, particularly to micro. Okay, so know about that tax incidence issue. So if demand is very elastic, the seller will pay more than tax. Demand is very price inelastic, the buyer will pay more than tax. Which is why, incidentally, why governments will tax goods that are very inelastic demand, such as cigarettes, alcohol, gasoline. These are goods that people are going to buy even if the price goes up. And sellers have gotten very good at pushing the tax on to buyers because we make the case that sellers are a little bit more cohesive in terms of their lobbying government. Okay. All right. Let's see here. Any questions so far? Okay. In chapter 6, we talked. Oh, there's a few questions dealing with the cost price elasticity. It's simply the idea that if one good is going up in price and the other good goes, and the demand for another good goes down, then what is that kind of a good? Well, it's probably a good that's a complement because if you're not buying one good, so that's called cross elasticity. That's one other topic we talked about. So look back on that, or it's more formally known as cross price elasticity. It's where the supply and demand of one good is responsive to the change in the price of another good. And those other goods involve substitutes and complements. And we go back to these pairing of goods that we talked about earlier in the class. Then we also talked about income elasticity, which is the idea of taking the income and determining how sensitive people are to changes in the price of the good based upon their income. If incomes are going up, people will demand more normal goods. Incomes go down, people demand fewer normal goods. Income goes up, they'll buy fewer inferior goods, they'll buy more normal goods when incomes are going down. Inferior goods react negatively to income, they go in the opposite direction. Okay, so know what those goods are. Inferior goods, they do come up again and again. And when we get into market structure, we'll talk about some industries that focus on goods, some which focus on producing inferior goods because they're really sort of trying to game the business cycle. Incomes are sometimes rising or falling depending upon the business cycle. And right now, it looks like we're sort of on the brink of maybe hitting into a recession. We're not quite there yet. We're maybe a few. When that happens, I think you'll see a lot of demand for inferior goods go up. It always happens. Maybe it won't be much of a recession, but we'll see. Okay. All right. Let's see here. What else do we want to say here? Okay. Chapter 6 deals with utility. And so we talked about utilities being the satisfaction or benefit we get from consuming goods. We measure it in a critical unit of value called a utils, which I know is sort of uncomfortable to a lot of people that we're using some unit of value you really can't put your arms around, but it nonetheless is a real thing because if goods didn't have utility that were on some continuum where we get more utility from some good and less from some other, then it wouldn't explain why we pay more for some goods and less for some other goods. Why are we willing to pay more for a flight to New York City than a bus to New York City? Because we'll get there faster and it's easier and it's more comfortable than it is taking a bus. And so we're willing to pay more for the flight than we are on the bus. It's because of the difference in utility that we perceive, which describes why we do that. So, and when we talk about this, there are a number of questions dealing with this idea of marginal utility that is incremental. And this is why I went over in class this idea of the three different kinds of values that we run across in economics. Totals, marginals, totals, averages, and marginals. Marginal is simply incremental. It's simply as we go from one level to the next. And sometimes it's 0 or 1. I go to New York City or I don't go to New York City, right? If I go on a flight and I pay this much, but if times do I want to go? Do I want to go twice? Maybe I got relatives there. Do I want to go once a year, twice a year, 3 times a year, 5 times a year? Like, do I lose value? Are they getting tired of seeing me? Going probably. So as a result, marginal utility is diminishing for pretty much any good. So pretty much for any good, marginal utility is a diminishing function. It's just, so maybe I go once and that's it, and I'm done for the year or for 5 years. But some things I do over and over again. I get a coffee every day. So my marginal utility, and I get maybe 3 cups or 4 cups, and it doesn't decline very much. So it's a very flatter kind of slope. And so you want to refer back to the class section, which we talked about flat versus steep marginal utility curves. And that is just the simple issue of how quickly marginal utility can diminish. But it does diminish. We know that it does. As the more we consume of something, in other words, the less something is scarce to us as buyers. You know, we get lots of value, but once it becomes less scarce, I mean, it becomes less and less value to the point where we can actually get negative utility because we could probably be doing something else. If all you eat is macaroni and cheese all day, which is I think what my son would like to do, you get, you know, and for whatever reason, it doesn't seem to be too much diminishing marginal utility. But over time, I think most of us would say, okay, enough with the macaroni and cheese. Let's go on to something else. And so marginal simply refers to incremental. Okay. Let me see here. So diminishing, so what diminishing function in general, and we run across it again with marginal product in chapter 7, which is a production concept, whereas utility is a consumption concept. But we did sort of identify marginals as being this idea of a diminishing function. Incrementally, it gets less and less powerful as things go along. Okay. Okay, and then when we talk about utility, know why utility is diminishing. We talked about some of the factors, and this was on a PowerPoint slide in our presentation. One is the substitution effect. It's simply the idea that, okay, why do I why after 2 cups of coffee a day do I want to choose something else? Because I've got other options. I can go get a Coke, or I can drink water, I can have orange juice, whatever. If the only thing that were available to drink would be coffee, then there wouldn't be much to talk about. But it's a substitution effect, and that's what determines the lack of scarcity, is that I've got other substitutes, so I don't have to be stuck with that. So this is why we've got hundreds of TV channels on our cable, because we very quickly lose interest if we can move on to something else. Okay, so marginal utility, know too that it can be positive, it could be zero, it could be negative. We can get negative utility from simply consuming too much of something. And so you want to know about that. Okay. And then know about the utils and what those are. It's just a hypothetical unit of value. Also know about the fact that because marginal utility is diminishing, it basically is total utility. So total utility kind of loses its slope. And I think I did an example of that in class, where total utility rises, and then it sort of tails off. And that's the whole idea of diminishing marginal utility. So you want to know about what's going on there. And then also, we talked about this idea of marginal utility per dollar. And it's the idea of how we measure marginal utility per dollar. It's basically the marginal utility of the good at the level that's being consumed divided by the price of that good. And we said that the optimal, what we call consumption bundle, is where there's a rough equivalence between the marginal utility and the price of one good, which equals another good, which equals another good. Even though the prices of these goods are all different, the marginal utility is different. We pay more for those goods that have higher marginal utility. We pay less for those goods that have less marginal utility. So theoretically, we have this balance over time as we make these mental calculations as to how much utility do I get. And I talked about the fact that we've all been in situations where we look to buy something, we say, oh, I like that. And we look at the price, oh, I don't like that, because we don't get enough utility for the price that they're willing to charge. And so it becomes a question of how much utility applies to us. Okay, so, and then there are some other things as well. If you're a famous hip hop star and you've got millions of dollars, maybe the price doesn't bother you. So your income and wealth may have an impact as well. Okay, but know that what that consumption bundle is simply a collection of goods that a consumer would make as a routine sort of purchase. Okay. Any questions so far? Am I going too quickly? Let me just check back in on the Zoom site, make sure nobody's texted me anything or put anything in the chat box. Okay, feel free to do that. And it's kind of a different kind of thing because class going on here. So, okay, oops, trying to get, okay. Trying to come back to try to get rid of this on my screen here. So, okay, well, shoot. Okay, all right. Okay, so, okay. We also talked about this idea of a budget constraint, also called a budget line. And it was this hypothetical model that plotted two goods, good A, good B, or good X, Y, whatever, with a budget, and that determines how much of one good we can buy in relation to a fixed income. We call it a constraint because we're saying that whatever that budget allows between two goods is simply the fact that it's a fixed income. And the fixed income proposition is not all that theoretical at all, because I think a lot of workers, a lot of people generally, it's not just retirees, but a lot of people have what is considered to be a relatively fixed income. Yes, there are people out there who have wildly variable incomes, salespeople who are commission only, people who work in entertainment whose jobs are very sort of lumpy and patchy. But most people have something like a fixed income. And even those people will oftentimes have some sort of fixed job that they go to, so they've got some sort of income to live on in case jobs don't come along. And that's one of the downsides, I guess, or ups and downs, depending on your point of view, about certain types of occupations where the jobs are just, they come to you when they come to you. So, okay. Okay, let me see here. What else do we want to talk about with regard to this? Okay. So I think that's really all that we wanted to get into with regard to chapter 6. Let's talk a bit about chapter 7. Chapter 7 is a pretty important chapter. There are a number of questions on the exam dealing with that. And we talked about this issue of cost. And I spent lots of time on chapter 7 because it's such an important chapter. We talked about the idea that inputs create costs and outputs create revenue. And so this issue of cost and revenue is an important one. It's not just important for econ, but it's also important pretty much everywhere else in business, frankly, in accounting, finance, everywhere. So you want to know what's going on there. You said fixed inputs create fixed costs. So fixed inputs create fixed costs, and fixed costs are defined as those costs which represent an inability to change the inputs. That is, you can't really change a number of warehouses in a very short time period, or numbers of big pieces of machinery. But in the long run, you can. So everything is variable in the long run. So all costs are variable in the long run. Even though we have variable costs, that's mostly short run situation. All costs are variable in the long run. Okay. Let me see here. So you want to know what some examples of the fixed costs are. Fixed costs are those costs, like we talked about this even a couple days ago: lease expense, interest, things like salaries of managers, those kinds of things. Salaries as opposed to hourly wages, or wages which are tied to production. Hourly wages, definitely. Overtime, managers don't get overtime usually, so that's what you're thinking about there. Variable costs are those costs which do vary with the level of production, and they would include things like materials and hourly labor and and overtime, that sort of thing. Okay, so you want to know what's going on there, and then know that total costs equal fixed plus variable costs. Okay, fixed plus variable costs equal to cost, and then we come to marginal cost, which marginal cost is related to this marginal change in output that we call total product. So marginal cost is the incremental cost as I go from producing one level to the next, to the next, to the next, to the next. But the idea in econ is the idea that we usually aren't talking about starting from zero and going to infinity. I mean, those are two endpoints that just really aren't part of the picture. Maybe if we're making refrigerators, we're making 200,000 refrigerators, and maybe next year we're thinking about making 210,000 refrigerators. So it's an incremental change, but what's that going to cost us to make that extra 10,000 refrigerators? And that incremental cost is something we factor into, and we'll get into it later as we determine how much revenue that will give us, and we'll see whether or not that makes sense. Because right now, all we've really talked about from the standpoint of the firm, which is Chapter 70 gets us into the economics of the firm after leaving economics of the consumer, and we're talking only about the cost issues facing the firm. But we'll bring demand back into it in Chapter 8, which is why I sort of kick the can down the road. I didn't want to sort of jam Chapter 8 into this. I think it's probably best not to, because Chapter 8 gets us more into the bringing demand and supply together. Okay, so know that the marginal cost is the incremental cost as we produce more units of output. Okay, so that's what marginal cost is. Also know about this idea of marginal product is diminishing, because it's the same idea as diminishing marginal utility. Utility is a consumer concept, and production is obviously a supply side concept. Okay. Okay, let me see here. Okay, they know how to calculate these variables, average, particularly the averages, average fixed cost, average variable cost. When you get an average, your denominator is always going to be total product, all the way back from zero to wherever you are. Any kind of average variable. So if it's average fixed cost, it's simply fixed cost over total product. If it's average variable cost, it's variable cost over total product. Total product is the same denominator all the way through those averages. The one that you might want to think about is marginal cost, which is why I drew this on the board, and I think that probably did get captured in the video. I don't think that was the invisible part of the board, but I went through the calculations of marginal cost. It's simply the change in total cost divided by the change in output. And so you get, and marginal cost will tend to go up over time, tends to go down, then goes up. It's kind of like the Nike swoosh. And it goes down because of these early stage gains from implementation of new outputs. And that's what's going on there. So people keep texting me here. I'll mute my phone there. So, okay. All right. So that's what marginal cost is. And then know that fixed costs and if fixed costs represent fixed inputs, then know that we have what are called lumpy inputs with regard to fixed inputs. That is, we can't add 1/10 of a warehouse. We have to build an entire new warehouse. So we see these are lumpy. We have to go all or nothing. Okay, and they're big. They're not like buying a piece of some material. It's doing a big big deal. Okay, so there's that. Let me see here. Okay, some things I've talked about. Okay, know what total revenue is. So total revenue is simply price of the good times the quantity of the good. And then the average total cost is really the unit cost, which we're going to be comparing total revenue against total cost a bit later. And well, I've already started to do it really in this chapter here, but know that you want to sort of make that calculation. Total revenue is price times quantity. Okay. Okay, let's see here. Know the fixed costs can be even 0 units of output. Fixed costs are what they are. They are fixed in the short run, so you want to make sure you are familiar with what's going on there. And let me see here. Okay, so you might have a small calculation here, and so you might want to have a calculator, but this is why I posted the spreadsheet, so you can get a good look at that. And I did not want to make this overly burdensome. I only went from 0 to 5 units, and there's a lot of columns columns this direction, but there are a number of variables to talk about. But I tried to make the math relatively straightforward. So, but you want to sort of be familiar with that. There's a reason why I took a lot of time to go over that, was because there's a lot going on there, and I think that it's going to help you to be reasonably comfortable with that as we get into this exam, because it's going to be coming up again and again as we get going. Okay. All right. Let me see here a minute. So just know how, if you're asked a question, compute average fixed cost or average variable cost. Know how to do that. What you might want to even do. I mean, this is an open book exam. This is the nature of online exams. But if you want to have like a little cheat sheet available, that might be a good thing. It's not cheating. Just a set of notes. AFC equals FC over total product. AVC equals VC over total. That sort of thing. Just so you can refer to it. So if you see a question, compute this, you can just refer to that. You've got it all together in one place. But you should have enough time that you can find that if you need to. But again, I know that a lot of instructors don't like open book exams, because they think that they probably have a point that it will encourage people not to be prepared, and so just thinking they can get all the material looked up during the time allotted, and I think that's a good, not a very good strategy for econ. It might work in some other courses, but and I just throw that out there just so you know my opinion is on it. I think they're fine to do. I just think that you might want to be cautious about relying upon that as a strategy. But anyway, you're all adults. You can do what you like as far as that goes. You have all the resources available that you want to use available. Okay, your text, the internet, all that good stuff. So it's fine to use. Okay. All right. So know that marginal cost is upward sloping, marginal product is downward sloping. There's going to be at least one graph, and you're going to want to take a look at that and sort of determine what's going on there. Now, we said that one important thing is that the marginal drives the average. And what do we mean by that? We're saying that when the marginal crosses over the average variable cost and total cost, it drags it up. It's because the marginal drives the average. It's like that idea of batting average, grade point average. So know what that is. Usually at the bottom point of the average variable cost, the average total cost curves. Notice the average fixed cost is not part of the issue here, because average fixed costs are not there. They're not relevant. Fixed costs don't change the level output, so it makes no difference. Okay, so you want to know what is going on with that. So just kind of refer back to that if you would, and that would be good. So just kind of be familiar with it. I know those curves are kind of busy. I think there's a lot of spaghetti going on, so I get that. But just kind of study it, make sure you're familiar with what's going on. Marginal cost goes down, so average variable cost and average total cost go down. Marginal cost begins to rise, it crosses over it, drags it up, right? Just like the batter in baseball hits a higher batting average in one day than the season average, it drags the season average up. Okay. All right. Also know about this issue of costs, because we talked about profit as being the difference between total revenue and total costs. But there's two different kinds we should think about. One is accounting profit, and that's simply total revenue minus costs, where the costs are only accounting costs or what we call explicit costs. Those are costs that are easy to measure. And they meet the accounting world's definition of a cost to be recognized, and that's objective, observable, measurable, and all that. And two people can agree because there's oftentimes some sort of source document. However, economic profit is what we tend to look at in economics, and that is the same calculation: total revenue minus total costs. However, total costs here include not just these explicit or accounting costs, but also what we call implicit or opportunity costs. And those are the costs of some value foregone. In class on Tuesday, Monday, I guess, I went over this example of a person who leaves his job, gives up a salary, and that salary is not something he doesn't write a check for the salary he didn't get, but the salary he didn't get is a cost that is implicit, it's baked into his economic situation. Okay, so just kind of know about that. And as a result, economic profit is going to be less than accounting profit, always. It can even be negative. It can be zero or negative. And if you wonder why firms do business over the long run, negative economic profit, well, we'll talk more about that. That's coming up a bit later. Okay. All right. We also talked about this idea of the long run, and there's something called the economies of scale. And I drew on the board here the idea of what we call the long run average total cost curve. It's basically saying, okay, these curves of average total cost are short run curves, but they're graphs of functions, and functions are equations. We can simply take one big long run average cost curve and say that in the long run, there are some firms that can operate where the costs are going down, and we economies of scale. This is a term that may be familiar to you. It's certainly one that is nearly in the public domain, and it's the idea that as we produce more output, our costs go down, and it's the idea that bigger firms tend to get bigger because it doesn't cost them very much to produce the goods. This is why, as I mentioned on Monday, that this is the reason why we don't make a lot of our own goods, because it's cheaper to go buy them, because whoever makes them doesn't cost them very much to make them at all, because they're producing so many units of whatever that good in question is. That's what scale does. And we're going to talk about the benefits of scale. Now, on the other hand, we talk about a less common case, but one that is also to be recognized. That's very far out on the curve. It's called diseconomies of scale. This is where costs go up as the firm produces more output. Here, the firm is simply too large, too unmanageable, too unwieldy. The example I gave, which is an example that you could probably find in numerous places, is that of General Motors back in the 80s and 90s, where the firm just got too big. Too many different companies operating under the corporate, too many vice presidents, too much administration, and really a lack of control. I think the company was out of control. And I gave my own example of, I thought Wells Fargo probably is in that case right now. I'm not picking on firms. I'm simply saying that from an academic standpoint, we look at what's going on and say, well, I think that these are difficult firms. Big firms are really hard to manage. And as a result, it becomes difficult to sort of control costs and coordination and all those kinds of things. And you kind of get these sort of make themselves manifest. Okay. Let me see here. I'm trying to think if there's anything else. Do you have any questions for me about anything? You want me to calculate anything or draw any curves or graphs or anything before we leave here? I'm wrapping up here a little faster than I thought I was going to, but anybody on the Zoom call? Okay, well, if you, I want to make sure you're getting your money's worth here, because I'm going to be here till 1:45. So if you do have questions, you can see me afterwards. For those of you who are here, if you are studying for the exam and I get that, reach out to me, send me an email, stop by my office, whatever you prefer, and I'd be glad to answer any questions you've got, including if you see a question on the exam that you think, wow, I don't really know. It might be difficult to reach me by email over the weekend in order when you're in the exam itself. But if you do have something as you're looking at things, feel free to give me a call or to email me. I'd be more than glad to try to get back to you as soon as possible. Okay. Well, that's all I had. So I'll hang around for a bit. And for those of you who are looking at it remotely or on Zoom, feel free to reach out to me as well over the weekend, and we'll be available. So look for the exam sometime tomorrow, on Thursday, that is, and it'll be available through the weekend. Okay. All right, everybody have a great rest of your day.